Hi, I'm Tim Kelly and welcome to this week's Video Insight. Today I want to give a quick update on our thinking in respect of Telstra in the context of the company's recently reported half-year results, as well as some other developments that have been in the press recently and which are relevant to Telstra's outlook and valuation. Firstly, in respect of the half-year results, there weren't many surprises there, with revenue, earnings and cash flow all broadly lining up with expectations. As the rollout of the NBN continues, Telstra's earnings and dividend continue to decline, and that will go on for some years. But the market has known about this for quite a while, and so it doesn't impact the estimated value of the company. Since we last commented on Telstra, however, there have been some other interesting developments covered in the press. Firstly, in December, the ACCC released a statement of issues in relation to the proposed merger between TPG and Vodafone. In particular, the ACCC was concerned that the removal of TPG as a fourth mobile network operator could lessen competition, raising the possibility that the merger may be blocked. Subsequently, TPG announced that it had abandoned its plans to become a mobile network operator, citing incremental costs that will result from the federal government's decision to ban Chinese company Huawei from taking part in the rollout of 5G mobile infrastructure in Australia. These developments make for an interesting and somewhat uncertain outlook for the structure of the mobile industry in Australia. But from our point of view, the implications for Telstra are a bit more straightforward. Given the critical importance of scale economies in mobile telephony, we think it's always been very difficult to see TPG becoming a vigorous and effective competitor in the premium end of the market, irrespective of the Huawei ban. Accordingly, our analysis has always assumed a limited impact to Telstra from the possible entry of TPG, and so our valuation assessment is not overly sensitive to the outcome of the ACCC's deliberations. Secondly, there has been increasing press commentary around the potential for a write-down in the value of the government's investment in NBN Co, which is really a discussion around whether the government is willing to reduce NBN Co wholesale prices. If those prices are reduced, then it's likely that the valuation would need to be written down. Once again, our analysis isn't overly sensitive to these developments. Our view is that NBN wholesale prices are too high, and over the long term, one of two things is likely to happen. Either the NBN wholesale price comes down to allow resellers to make a commercial margin, or those resellers with a mobile network will increasingly bypass NBN with fixed mobile services on which they can earn a commercial margin. Either way, we anticipate improving economics for Telstra relative to the current situation. In summary, while there are a lot of moving parts to the Telstra discussion, our long-term thesis remains largely as it was. Telstra needs to become more efficient, and it is working hard to achieve that. Assuming it executes well, we think the company's scale and market position should allow it to benefit from good growth in mobile services as 5G technology is adopted, and we think that the market may not be pricing in much of that benefit. Accordingly, we continue to be happy to hold a position in Telstra. Thanks for watching, and don't forget to follow us on Facebook and Twitter.